Today I'm going to talk about 4 of the best tax savings vehicles for high income earners. I've written about all of these topics separately in the past, but thought it would be worth covering them in a bit more detail in one video. Hold on as we cover some great tax saving ideas for high income earning Gen Xers. Some time ago, Michael Kitces wrote a great article for his blog, Nerd's Eye View. The title of the article is The Hierarchy of Tax Preference Savings Vehicles for High Income Earners. The title is a mouthful, but the content is great. I'll put a link below in the description to his wonderful article. He hits on 4 tax savings vehicles that every high income earner should be utilizing. Because I specialize in working with Generation X, these are ideas that make perfect sense for them. Enough of that. Let's dive into the first vehicle. The top of the list, or bottom of the pyramid, if you will, is the Health Savings Account, better known as HSA. For years, I've been describing HSAs as the triple threat. I used to say triple crown, but it really has nothing to do with horses. HSAs are available to people who participate in a high deductible healthcare plan. The basic concept is this allows you to save for healthcare expenses in retirement. Estimates for retiree healthcare expenses vary, but the common theme is to expect total expenses of nearly $250,000 for a married couple. Wow. Now, you may be familiar with the Flex Spending Account, better known as FSA. This is where you put some pre-tax money aside for medical-related bills in the current year. Payroll puts the money aside, you incur the cost, and then you either pay for it with your FSA card or you request reimbursement. There is a small amount of the unused funds you may be able to roll over to the next year. But the concept is the FSA balance should be used in the current year in which it's funded. The HSA is different in a few key ways. Yes, the money does go into the account before taxes are taken out, but you can leave the money in an HSA well beyond the year in which you make a contribution. Better yet, you can invest that money and it grows without taxes. Finally, as long as you take money out for qualified expenses, the distributions are without taxes. That's right. No taxes on contributions, none on growth, and none on qualified distributions. Plus, the money can grow for years in order for you to use the funds decades later for retiree healthcare costs, which I don't see going down in the future. Now, there are limits on how much you can contribute to an HSA annually. For 2020, that number is $3,550 for individuals, and you double that to $7,100 for families. There is a $1,000 catch-up for age 55 and above. One final comment. Some of the big thinkers in my world of personal financial planning feel funding an HSA before you max out your 401k is key. The next 2 tax savings vehicles are double plays. Doing an awful lot of baseball analogies here. These are double plays because they have 2 types of tax savings. The first is the good old 401k, 403b, traditional IRA, and similar tax savings vehicles. These are all pretty straightforward, but let's do a quick refresher on how the tax advantages work. 401ks, 403bs, IRAs, and more have 2 distinct tax advantages. The first is contributions go in before taxes. Next, they grow over time without taxes. Unfortunately, when you take money out of them, Taxman is waiting for you. This includes once you're old enough to reach the magical age of required minimum distributions, better known as RMD, and Uncle Sam says he finally wants his tax dollars. Even with taxes at the end, this is still a great tax savings vehicle for high income earners. So who's in third place? Here we have the good old Backdoor Roth. As a refresher, there are income limits for participating in Roth IRAs. Well, contributions go into a Roth after taxes, they grow without taxes, and there are no taxes on qualified distributions. The issue for high income earners is they cannot participate directly in Roths. Simply, they make too much money. But wait, there's more. The Backdoor Roth allows high income earners to contribute after-tax money to an IRA. Once this is done, they then can convert it to a Roth IRA. It's a rather straightforward process, but if you have any money in a traditional or rollover IRA that's not been taxed, it does get a little more complex. Definitely consult your CPA before doing a backdoor Roth. But the basic complication is Uncle Sam combines the balances in your traditional IRAs, rollover IRAs, and your backdoor Roth. Because I'm a simple guy, I'm going to keep this example simple. Let's say you have $95,000 in a rollover IRA because your advisor convinced you to roll that old 401k balance to an IRA he can manage and charge a fee on. If you put $5,000 of after-tax money into a backdoor Roth, Uncle Sam will combine those two balances. He will then let you know that 95% of this backdoor Roth is taxable, again, because 95% of the total IRA balance has not been taxed. Again, talk to your CPA before doing this strategy. The final tax savings vehicle is the most complex one, the one that could give you the biggest bump to retirement savings, the Mega Backdoor Roth. I first heard of the Mega Backdoor Roth from White Coat Investor. To execute this strategy, you need a very forward-thinking employer. Before you start getting too excited, contact your human resources or benefits people to find out the answers to some questions. First, do they allow after-tax, non-Roth contributions that can be maintained in a separate account? And do they allow in-service withdrawals? If so, let me share a simple example of the benefit of the Mega Backdoor Roth. Now, your employer can meet the requirements I just mentioned, but they do not provide an employer match. You're also 50 years old. You max out the employee contribution of $19,500 plus the 50-year-old catch-up of $6,500 for a total of $26,000 put in by you as employee. The total amount allowed between employee and employer is $63,500 for 2020. You can put in another $37,500 into the separate after-tax non-Roth account. Then you do an in-service withdrawal of this $37,500 into a Roth IRA. If your employer does any kind of match, short of getting your combined contributions to $63,500, you can contribute the difference with the intent of doing the Mega Backdoor Roth. Now, this is definitely one of those vehicles to talk to your CPA about. But if it's allowable by your employer and you have the financial ability to do it, it's definitely worth the consideration. All right, so those are the top 4 concepts. There are lots of other great tax savings vehicles like the Roth 401k. Please share any ideas you have in the comments section. Just keep it legal. Thanks for tuning in. The plan is to create one quality video a month, so please subscribe. Also, please share any feedback in the comments section. I'm always looking to improve my content, and if there are certain topics you'd like me to cover, just let me know. Thanks for tuning in.